not at all, and I think I've heard this already a number of times. First about the internet, then telephone companies were again signaling the end of banking. I think what is more important is to first define banking itself, because the definition is what is going to help us to better understand the risks that we're facing and the disruptive threats that we're coming across. One of my favorite examples is an article from the 1960s that was using the railway industry as a good example of an industry that had a very bad definition of what they were doing. Railway executives thought that they were in the railway business and therefore they have no competition. And as a result, they, being a natural monopoly, they were less agile to respond to the threat of airplanes or even the post. In banking, I think using the term banking as an umbrella term is a little bit unfortunate. Our business has to do a lot more with the components of what we call banking, such as lending, transaction processing, payments, advisory, etc. So is Fintech going to mark the end of banking? I don't think so. Is Fintech going to change the number of the components that fall underneath banking? Then yes, a lot more likely. There's a lot of hype around Fintech at this moment, which is kind of normal, but we have to keep in mind that it's not the first time we're experiencing disruption in an industry coming from the outside. It's not a new phenomenon. Actually, the first time that disruption was officially noted was by Karl Marx and Engels at their Communist Manifesto. And more recently, Joseph Schumpeter spoke a lot about creative disruption. What I'm trying to say is that even though what we're seeing at the moment is obviously a new phenomenon, having financial technology companies trying to disrupt banking, disruption and technological innovation is not something new. We have a much better chance of understanding fintech as a phenomenon, the threats that it poses and the ways that we can react to this by looking at what has already been studied rather than by sitting and assuming that it's something so new that there's nothing that we know about it. Predictions are difficult, especially when they have to do with the future. So I think what we're better off doing is, as I said earlier, we can look at the components of what makes up banking, the different sub-industries that make up banking, in order to try to give a response to this question. Another thing that is very important and we need to keep in mind when we're thinking about disruption is technological disruptions, that you have two types of technological innovation. You have what I call technological enablement, which is you do the same thing that you did before, but you do it faster, cheaper. Online banking is a good example. Okay, before I had to go to the branch to make a payment. Now I can just do it online. But this is just technological enablement. What is probably more interesting when we're looking at the field of disruption is technology-enabled business model innovation. So when we're using technology to introduce a new business model that we would not have been able to have in the past without the use of technology. And again, we're seeing a lot of examples at the moment, such as peer-to-peer lending is one example where technology has given us the opportunity to do something different. The same thing in insurance, peer-to-peer insurance, etc., etc. What for me is important when we're thinking about firms and saying displacement of banks from fintech firms, again, I will run some parallels to the airline industry, where we had the low-cost airlines coming before, Southwest in the United States, EasyJet, Ryanair in Europe. And there was, again, a lot of talk about the fact that all the traditional carriers would get displaced by the new joiners. What we actually see at the moment is a model of coexistence, and I feel that in banking it's not going to be very different. I believe that in a few years' time what we're going to have is going to have the small specialist technology players that, just like the point-to-point airlines, that will be doing something relatively simple at a low cost and a low price to the customer. And then we're also going to have the full-service banks, just like we have these full-service airlines. They'll be more expensive, but there will still be a market for them. Obviously, the market share, the share of the bigger pie is likely to grow. But again, I don't think we're going to have a complete displacement of banks. Having said that, as I said, banks cannot be complacent, and they're not complacent, because we will have a lot of shift of at least some of the more basic payment, transaction processing, etc., components of banking into this sector. The answer is obviously a little bit of yes and a little bit of no. So, I mean, clearly we have new risk types that have come up, like cyber risk, something that 30, 40 years ago we had never imagined would exist. At the same time also, we have simply new expressions of older risks that are still as prevalent as they were before. If we look at the peer-to-peer lending environment that I referenced earlier, what you can see is that credit risk, liquidity risk remains as relevant as it always was. For me, what is also equally important is that we can use technology to actually alleviate or better manage from the foundation some of the risk types, and technology can help us to do that. My favorite example is the way that the technology is used in peer-to-peer insurance networks in order to reduce the moral hazard embedded in insurance contracts. By building a network of people that know each other, with the use of technology, the peer-to-peer insurance companies are reducing the likelihood of false claims and also possibly the probability of clients jumping at renewal time from one insurance contract to the next. We spend a lot of time thinking about unicorns, and we're seeking unicorns. And in the end, portfolio theory is all about losses, wins and losses. If somebody is looking to make big money without any losses in the fintech space, that clearly is not going to happen. If somebody is looking to make more gains than losses out of investing in the sector, that is possible, but don't ask me to tell you what is the investment strategy you should follow.